Arbitrage refers to the simultaneous purchase and sale of an asset such as stocks, bonds, currencies, or commodities in different markets to profit from price differences between them. It takes advantage of inefficiencies in the market, where the same asset may be priced differently in separate exchanges or locations. In an efficient market, these price differences should not exist for long, as arbitrageurs traders engaging in arbitrage quickly exploit them, pushing prices back into alignment. Imagine stock A is trading at $100 on the New York Stock Exchange NYSE, but at $102 on the London Stock Exchange LEAS. An arbitrager would buy the stock for $100 in NYSE and simultaneously sell it for $102 in LEAS, making a risk-free profit of $2 per share minus transaction costs. Pure arbitrage, the most straightforward form of arbitrage, where an investor buys an asset in one market and sells it in another at a higher price. Risk arbitrage. Merger arbitrage involves betting on the outcome of a merger or acquisition. When a company announces plans to acquire another company, the stock price of the target company often rises, while the stock price of the acquiring company may fall. Arbitrageurs might buy the target company's stock and short the acquiring company's stock, betting that the merger will go through as planned. Statistical arbitrage, a more complex strategy that uses mathematical models to identify pricing inefficiencies between securities. This often involves high-frequency trading and sophisticated algorithms to capture small price differences. Triangular arbitrage. Currency arbitrage. In the foreign exchange market, this involves converting one currency to another, then to a third currency, and finally back to the original currency, profiting from discrepancies in exchange rates. If the exchange rates between USD, EUR, and GBP differ in different forex platforms, you can cycle through conversions to make a small profit. Convertible arbitrage. This is a strategy applied to convertible bonds. A convertible bond can be converted into a company's stock at a certain price. Arbitrageurs may buy the convertible bond and sell short the underlying stock to profit from the pricing difference between the bond and stock. Fixed income arbitrage, a strategy that involves exploiting price differences in fixed income securities like bonds or interest rates. Covered interest arbitrage. It occurs in the foreign exchange market when investors exploit the interest rate differences between two countries by using forward contracts to hedge against currency risk. Key terms associated with arbitrage: spread, the difference between the buying and selling price in an arbitrage trade. The spread is what the arbitrager aims to profit from. Hedge. A hedge is an investment that reduces the risk of adverse price movements in an asset. In the case of arbitrage, traders often hedge their positions to protect against the risk that price differences disappear before the trades can be executed. Market inefficiency. Arbitrage relies on temporary market inefficiencies, where the same asset is priced differently in different markets or forms. These inefficiencies typically exist for a short time. Convergence. In arbitrage trading, convergence refers to the process of the prices of two assets moving toward each other. Arbitrageurs profit when price differences between markets narrow. Short selling. Selling an asset that is not currently owned, with the expectation that its price will decrease, allowing it to be bought back at a lower price later. Short selling is often involved in arbitrage strategies. Transaction costs. These are the costs incurred when buying or selling securities, including broker fees, taxes, and other charges. High transaction costs can erode arbitrage profits, making it less viable. Liquidity. Liquidity refers to how easily an asset can be bought or sold in the market without affecting its price. Higher liquidity makes arbitrage more effective since trades can be executed quickly. High-frequency trading HUFT. Many arbitrage strategies today are implemented using HUFT, where sophisticated algorithms are used to execute trades in milliseconds to take advantage of fleeting price differences. Arbitrager. A trader or investor who engages in arbitrage is called an arbitrager. These individuals or entities use complex strategies and technology to exploit market inefficiencies. Price discrepancy. The central point of arbitrage trading, where the price of an asset in one market differs from its price in another market, creating an opportunity for profit. How arbitrage affects the market price efficiency. Arbitrage plays a vital role in maintaining market efficiency. When arbitrageurs buy undervalued assets and sell overvalued assets, they push prices toward equilibrium, reducing price discrepancies. Risk-free profits. Ideally, arbitrage is considered a risk-free profit, but in practice, there are often risks, such as execution risk, price slippage, or market volatility. Arbitrageurs rely on fast execution to minimize these risks. Market integration. Arbitrage links global markets, ensuring that prices across different exchanges or regions remain aligned. For example, arbitrage in currency or commodities markets ensures that prices in one country don't diverge too far from global norms. Challenges of arbitrage. 1. Execution speed. As more traders and institutions use advanced algorithms for arbitrage, competition has increased. Speed is crucial, as price discrepancies often exist only for a short period. 2. Transaction costs. Fees, taxes, and brokerage charges can eat into the profits from arbitrage, especially when the price differences are small. 3. Market risk. Price movements can change unexpectedly before trades are executed. Arbitrageurs must act quickly to avoid adverse price movements. 4. Liquidity issues. If markets are illiquid, it may be difficult to execute large arbitrage trades without influencing prices. Conclusion. Arbitrage is a crucial concept in financial markets that helps ensure price efficiency across different markets or assets. By exploiting price discrepancies, arbitrageurs play a vital role in keeping markets in balance. While arbitrage is often seen as a risk-free strategy, in practice, there are challenges such as execution risk, transaction costs, and competition that can impact its profitability. High-frequency trading and modern technology have become essential tools for arbitrageurs to stay competitive in fast-moving markets. Let's dive deeper into the challenges of arbitrage as opposed to arbitrage, focusing on execution speed, transaction costs, market risk, and liquidity issues. 1. Execution speed. As more traders and institutions use advanced algorithms for arbitrage, competition has increased. Speed is crucial, as price discrepancies often exist only for a short period. Execution speed is one of the most critical aspects of arbitrage. The opportunity for arbitrage exists because of price discrepancies between markets, but these discrepancies tend to be short-lived. The rise of electronic trading, sophisticated algorithms, and high-frequency trading has increased competition in the arbitrage space, reducing the time window in which these opportunities exist to mere milliseconds. 1. Execution speed. As more traders and institutions use advanced algorithms for arbitrage, competition has increased. Speed is crucial, as price discrepancies often exist only for a short period. Execution speed is one of the most critical aspects of arbitrage. The opportunity for arbitrage exists because of price discrepancies between markets, but these discrepancies tend to be short-lived. The rise of electronic trading, sophisticated algorithms, and high-frequency trading has increased competition in the arbitrage space, reducing the time window in which these opportunities exist to mere milliseconds. Challenges related to execution speed. Latency. The time delay between placing and executing a trade is known as latency. In arbitrage, even a small delay can make the difference between capturing a price discrepancy and losing the opportunity. To mitigate this, arbitrageurs use cutting-edge technologies like direct market access (DMA) and collocation, where their trading servers are located physically close to exchange servers. Market response. As soon as arbitrageurs spot price discrepancies, their actions tend to close the gap quickly. This makes it essential to not only execute trades at lightning speed, but also to continuously monitor markets for fleeting opportunities. Technological infrastructure. To compete in arbitrage, investors must invest heavily in high-speed networks, powerful servers, and real-time market data feeds. Even a microsecond of delay can be the difference between a profitable trade and a missed opportunity. 2. Transaction costs, fees, taxes, and brokerage charges can eat into the profits from arbitrage, especially when the price differences are small. Transaction costs. While arbitrage profits come from small price differences, transaction costs, for example broker fees, exchange fees, and taxes, can quickly eat into these profits. Arbitrageurs must account for these costs when calculating whether a potential trade will be profitable. Challenges related to transaction costs. Low margins. Arbitrage opportunities typically offer slim profit margins. When transaction costs are high, these margins can disappear entirely. For example, if an arbitrage trade would earn $100 but incurs $80 in fees, the potential profit is dramatically reduced. Cross-border arbitrage and international arbitrage, such as currency or commodity arbitrage across exchanges in different countries. Transaction costs can include currency conversion fees, foreign transaction taxes, and compliance costs. Slippage. Slippage occurs when the actual execution price differs from the expected price due to rapid market movements. This discrepancy can further reduce the profit margin, especially when combined with high transaction costs. Volume and fees. To increase profits, arbitrageurs often trade large volumes of assets. However, higher volumes may come with higher fees, or the trader may face liquidity issues if trying to buy or sell too large a quantity at once. 3. Market risk. Price movements can change unexpectedly before trades are executed. Arbitrageurs must act quickly to avoid adverse price movements. Market risk. Arbitrage is often perceived as a risk-free strategy because of the simultaneous buying and selling of assets. However, in reality, there are several market risks involved that can affect the profitability of an arbitrage trade. Challenges related to market risk. Execution risk. This arises when the price of the asset changes between the time the arbitrager identifies the opportunity and when they can execute the trade. For example, in a fast-moving market, prices can shift quickly, eliminating the price discrepancy and leading to losses. Regulatory risk. Regulatory changes or interventions can affect the pricing of assets or impose restrictions that impact arbitrage trades. For instance, capital controls, currency restrictions, or short-selling bans can alter the landscape for arbitrage in certain markets. Counterparty risk. If an arbitrage trade relies on a counterparty, for example, a broker or a clearinghouse, there's a risk that the counterparty might default or not fulfill their side of the trade. This is especially pertinent in over-the-counter OTC trades or less liquid markets. Volatility. Sudden spikes in market volatility can cause prices to move unpredictably, making it difficult to complete arbitrage trades profitably. During times of extreme volatility, price gaps may close too quickly, or execution may be delayed. 4. Liquidity issues. If markets are illiquid, it may be difficult to execute large arbitrage trades without influencing prices. Liquidity issues. Liquidity refers to the ability to buy or sell an asset without significantly affecting its price. Arbitrage depends on liquidity because traders need to move in and out of positions quickly. Challenges related to liquidity. Illiquid markets. In markets with low trading volume or liquidity, it may be difficult to execute the large trades needed for arbitrage. This can result in higher transaction costs, or the price may shift significantly by the time the trade is executed, reducing or eliminating the arbitrage opportunity. Bid-ask spreads. In illiquid markets, the difference between the bid-buy and ask-sell prices is often wider, making it harder to capture a meaningful profit from arbitrage. If the spread is too wide, the arbitrager may not be able to realize a gain after accounting for transaction costs. Impact of large trades. Even in liquid markets, placing a large order to exploit an arbitrage opportunity may move the market. This is particularly true in smaller markets or for less frequently traded assets. When an arbitrager tries to buy a large amount of an asset, the increased demand can drive up the price, reducing the price discrepancy they are trying to exploit. Clearing times. Some markets have slower clearing times, the time it takes to settle a trade, which can prevent arbitrageurs from profiting from short-lived price discrepancies. For example, differences in settlement periods between two exchanges can create a lag, making it difficult to execute arbitrage. Conclusion: while arbitrage is often described as a risk-free or low-risk strategy, the reality is more nuanced. The need for speed, the impact of transaction costs, the potential for market risks, and the challenges of liquidity are all factors that can complicate arbitrage strategies. Arbitrageurs must invest in sophisticated technology, execute trades quickly, and carefully manage their risks to maintain profitability in an increasingly competitive environment.